Hi guys, Harry Otis here, professional trader for 20 years now. Started my career in 2005 and still alive in 2026. My. Today, jobs report, NFP day, Friday, the 5th. The 5th. I plead the 5th today because the market just tanked bigly, minus 2.6%. And it's tanking on the jobs report. Okay, we're going to get into detail on that and talk about some sectors that I like and look at some of our positions if we have time. So, but always we talk about this technical picture on the 5th of June today. Very, very devastating. Very, very devastating. But guys, we were saying prepare for this down move. Okay, as this market was going up for the past week or so, we were saying that there was negative divergence on the charts, seeing the price was going up and the RSI was going down. Okay, and it looked like the market might go higher to negate it, but no, it didn't. It never did. Okay, so right now we just had the negative divergence play out. We don't know how much deeper it goes. I suspect we go a little bit deeper. I suspect because we close to the lows that we gap down open on Monday, and there's going to be maybe a little bit more pain. Who knows? We don't know what's going to happen over the weekend. But this just destroys all of the call buying. We were saying there was a lot of calls being bought. This destroys it. We were saying that a lot of people, the negative divergence, we saw the SMH here also with negative divergence. See, price was going up and it was going down. The RSI was going down and the MACD was going down. It was more pronounced than SMH. And now SMH, we had a 9% drop. Okay, exactly what we expected would happen. The most likely scenario that we expected would happen. We thought there was an unlikely chance that it would just blow off to the top, but usually things don't work out that way. Usually things work out in a lockstep fashion like we see here. So the technical picture, guys, bullish. I'm going to say still bullish. If we bring in the moving averages, we technically ripped down and closed below the 20, so people are probably taking profits, okay? But we're still trading above the 50 and the 200, and we are approaching the 50. Before we were very, very stretched, okay? As the 50 goes up, we might be able to meet it in like a week or two. We have another down day like that. We're going to meet it tomorrow, Monday. And we were suspecting that we could close this gap at 725. It could happen tomorrow. Again, when I say tomorrow, I'm shooting Friday, so I mean Monday. Okay, so yeah, it's playing out exactly like we thought. The moving averages, they're still strong. We closed today, we cut through a knife through butter through the 20, but everything is still upward sloping and we're still above the 50 and the 200. So no need to panic just yet. Okay. We just suspected that technically speaking, we had to get rid of a lot of people were buying calls. We have to get rid of these Johnny come latelys. Okay. So what does the sentiment tell us? The sentiment today, we were at neutral to greed here and boom, like we suspected, one big down day, we're going to go into fear. Okay, exactly what we wanted. The momentum now is not greedy. It's not extreme. It's at greed. Everything is at fear, except the put call ratio. I suspect it's lagged. So I suspect today a lot of puts were being bought. And if we go down Monday, Tuesday, Wednesday of next week, this is going to really go into the fear and extreme fear. Market volatility is still neutral. Okay, but everything else is fear. So we're starting to go into all this fear stuff. We're starting to go into the fear and extreme fear segment, which I like. Okay, perfect. This is what we wanted, okay? Guys, we're net long and we had some short exposure. So our short exposure is working. However, we are net long, so it does hurt. But you have to prepare for it. You have to prepare for these down moves. Okay, you have to know what you're doing and you have to hold what has fundamental value and what doesn't, okay? And right now we're still bullish. So yes, you're going to have these crazy days on high volume. It's going to happen. Okay, so and we are expecting it. So it still hurts. We say it's going to hurt. Okay, but you have to know, you have to prepare, and you have to have a plan and draw it out. Okay, and what we did was we expected it to cut to 725 before we're starting to buy more of the market. Okay, so let's get to the big news. Market tanking on the jobs report. Okay, the jobs report, U.S. payrolls. What do we have here on CNBC? U.S. payrolls rose by 172 in May, much more than expected, and the unemployment rate is 4.3. I think they were expecting 85K. They got 172. Now, that freaked everybody out. Why? Because if we look at the Fedwatch tool, when the jobs are doing well, rate hikes are in the game. Okay, now we're looking at the Fedwatch tool for December of 2026, all of 2026. This column here, 3.5, is no hike. Now, the hike, one hike in 2026, 42% chance. But a 20% chance for two hikes and a 4% chance for three hikes because of the great jobs report. You see, we wanted a narrative change. We wanted a narrative change that will make the market go down, and we got it. It was flimsy. It was like any kind of spark to bring the market down was going to happen because everybody was parked super long. Okay, so this is what we expected to see. It was the most likely scenario. We're getting it. Okay, so and the reason for that is because now we have a 67% chance of a rate hike. If you add all those three columns together, it's 67% chance of at least one rate hike, 20% chance of two, 4% chance of three. Okay, so this is what's destroying the markets. And as you can see, is it really, really that devastating? If we go to the US 10-year yield, yeah, the yield is up today, but it's still not at the highs. Still not at the highs it was when we were really, really tanking in around here, around these times. When was it? Here? As this market was going up, the yields were going up. But today, the US 10-year, it's up. And you could argue that if the market continues to go down, it will continue to go up. And maybe if it hits the 4.75 level again, like it has before, it will get rejected. Who knows? But as of right now, as the market is falling, this is just a slight move higher, 1.36%. Okay, we are still high, but not at red zone level like we had before. At red zone levels, something's happened. People move, machinery goes, the little ants start moving, and things happen, and it goes back down again. Okay, we have to see. We don't know yet, but I suspect that this move is a temporary narrative. Okay, I suspect this jobs report is a temporary narrative, even though the rates are much higher. I think this gets unwound. I think this puts pressure on Trump to end the war, because if oil starts going down, the inflation narrative will stop, and it will. And the jobs might not be that great. Okay, like if we looked at the jobs report here on Zero Hedge, you can see that government. This is the breakdown of the jobs report. Government added the majority of the jobs growth. They added 55K local government, and education and healthcare was 40. So that makes 95 plus 70K from leisure and hospitality, which is like part-time jobs, I guess, which happens during the summertime. So this accounts for everything. This is the biggest government surge ever. If it wasn't for that, jobs would have met the expectation of 85K. Okay, and probably even less. So maybe not. It would have been 120. What was it? 170? Yeah, 170 minus 50. Yeah, about 122, which is still pretty good. And the job market is doing great. We kept saying it. The initial claims are not that bad. The jobs are doing great. But that stokes fears of inflation. Okay, as the markets go up, jobs are doing great. A lot of money gets printed, and we have inflation plus the oil plus the war adds to all these fears. So rate hikes, boom. Now we're in a rate hiking cycle. This is again fear. Okay, and we're seeing it develop very, very fast. Boom, into the fear. Another day like today, we're going to get really close to the extreme fear. Okay, and if we cover this gap, and if we really retest this 700 highs, like that would be a drop of what, 60, almost 8%. That would be devastating. Okay, this would be an ideal time to buy. Buy a little bit here. We'll have to see when it gets to the extreme levels. We don't know. This could be just a down move before going up. I don't know. I don't think so. I think we continue to go a little bit lower. We need to get a lot of pain. We need to have some short-term pain from all this gain. So a lot of people will be dumping, especially when they buy at the highs. Okay, so we need those guys to get wiped out. Okay, and we saw SMH, like we mentioned before, going down. Okay, we expected it to cover this gap, which is 520, which would be big, very big. Okay, and we have a trade. Remember, one of our shorts is Intel Corporation. We got assigned the 88 short call here, but we have like $8.15 credits. So I suspect it goes down, and I'm short, and I expect to cover as it goes lower. I expect we see a lower, a move down in the semis, and other sectors picking up the slack. Okay, but it's going to hurt in the SPY in the short term. That's what I'm suspecting. I'm suspecting to see a real hit in the SPY. Okay, so what are these interest rate hikes and this fear and the market and the job market, and what does that do to my favorite trade right now? It's gold. Okay, gold market tanking. Remember we talked about gold? I accumulated here. because we're at the 200, close to 200. Well, today we ripped down below it. Okay, I've been trading gold for years, decades. Okay, and it always looks the worst. It always looks extremely bad, very terrible. The chart breaks down, everybody goes short. I'm expecting even down, a bigger down move, maybe a little bit more. Destroy, close below the 200. Now everybody's bearish. Okay, go even lower, get it to get the RSI down to extremes, make it like, positive divergence on the charts, get everybody super scared. Okay, because this trade, okay, we are setting up to have a multi-month up move, okay, but we suspected that it'll be for 1 month pain. Okay, it's very, very painful when you're in the middle of it, and very, very difficult to pull the trigger. Okay, if you look at any metric, one of the things that I like to look at is the bullish percent, gold miners bullish percent index. It's the amount of the gold miners in terms of a point and figure charts, how many of them are showing bullish patterns or bearish patterns. Okay, and we're at 7.69% of gold miners are showing bullish patterns. So you can do that with any kind. You can look at how many, the percentage of gold miners that are above their 50-day moving average, or the percentage of gold miners that are above their 200-day moving average, and you can see historically how low it is and how extreme the sentiment gets. Okay, but here this is a daily chart. This is a weekly, okay, and only a 1 year chart. It doesn't really show much on the 1 year chart. We can go to 5 years to show you how extreme it is. We're at 7.69, 5 years. We've been lower. During this crash, we were at 3. During this crash right here, let's go to the market, SPY. When SPY was crashing here, down 10%, we were at 3 in the gold miners. The gold miners were tanking. I think it's this crash right here. Okay, it coincided with Turkey selling all the gold. This crash, we were at 3. Okay, it's very rare to see. If you look at, it's very rare to see anything under in the single digits. We got 2 like within 2 months. Okay, like that's a 5-year chart. Let's go to a 10-year chart. Okay, you can see that anything in the single digits, 10 here, anything in the single digits, maybe you guys can see it here. Okay, I'll go blow it up bigger. Anything in the single digits happened what? 1, 2, 3, 4, 5 times in the past 10 years. So once every 2 years. Okay, we had it here in November 2016. I remember that. 2020, the crash. Here is 2022 bear market. Look at it. And of course, here was the Trump war. And now, look at it now, 7.69. Okay. This is a weekly chart. So look, it takes time for it to play out. Once it gets to these levels and it rebounds, okay, once it gets to these levels and it rebounds, let's take 2022 as an example. It gets to these levels and it rebounds, okay? It takes months after before it gets back to above 50 or above 70, meaning 50% or 70% of the gold miners are showing bullish patterns, okay? Look, it happened here in September of 2022, and it took by April of 2023. So basically 7 months, okay? It takes time. Okay, even in 2022, when they printed a crap load of money, it was from March and it took into July. What is that? 5 months? So even the quickest move up from extreme like single digit levels takes, months. Okay, so we're at this point. It happened. Now it's twice in like a couple month period. This is very, very bearish for the miners. So a bearish, bullish. Okay, I am itching. I bought and I'm itching to go long. I have that itch in my bones to just buy more. I want to buy, but I have a disciplined approach. I'm buying a little bit every week for the next 2, 3, 4 weeks. Okay, I believe that we are very, very close to a bounce in the gold sector and in gold miners. But I play the miners based on the gold price here. Okay, like if you look at the miners, the GDX, they too break it down below the 200. Nobody wants them. Okay. It's going to be on high volume. Okay, so everybody's like hates this chart. Okay, it's probably going to break down below and go to the RSI of like 30. Who knows? I suspect that we still have more downside to go, but we are close in terms of time. I don't know in terms of price how low we go. We could really tank. Who knows? Okay, but every time it's different. But right now, I suspect that we are getting close to. We are in the midst of a buyable bottom in gold, but it could take time, weeks, before we see the bottom. So be cautious. Buy systematically a little bit every week, okay, which is what I'm doing. And it's going to take months before we go back to the highs. Recognize this is not a day trade. This is not a week trade. It's a long swing trade, okay? But you can make 50, 100% return on your miners if you buy them correctly, okay? If you can't, just buy the GDX if you don't know, but it's going to be, I think this is the opportunity, and nobody cares about gold. Everybody thinks it's going to get destroyed because of high rates. Well, not necessarily. We've seen high rates from 2003 to 2006, and gold appreciated from like what, $300 to $1,000. So it's not necessarily a bad thing. Okay, it all depends on the circumstances surrounding gold. Okay, that's a lot for today, guys. I tell you, we had a lot to cover. Okay, this is a very big day. Let's get rid of the moving averages. I suspect we continue. We gap down on Monday. We probably, maybe over the course of a couple of days, hit the 725. We'll see what happens. I'm looking to buy into the market, and of course, I'm in the midst of buying in gold. All right, guys. Crazy start to June. Later.